doing this a very, very long time. Yes, I have a lot of credentials behind my name only because I've been in the business so long. And I believe education is very, very important. Education is the only thing nobody can ever take away from you. So education is important. But what we're trying to do today in today's session is educate you on the Canadian rules so you understand the Canadian information. But let me just tell you a little bit more about myself. I'm happily married, going on 35 years. My wife is a teacher. My wife is much smarter than me. She's a very smart individual. I have 2 beautiful children. My daughter is a nurse. My son's a master electrician. My daughter, we're very blessed, gave us 3 beautiful granddaughters. My oldest is 10, then we have a 7, and we have a 5-year-old. My oldest last night was at the Cat game, part of the cheerleader squad. So I'm very important. I love my grandchildren. But you know, the other thing about me is my parents are still alive. I have 2 older parents. They still live on their own. They're in their 80s. My dad grew up as a Boilermaker. And I bring that up because he worked hard all of his life. If you don't know what a Boilermaker is, he's one of those people you see all those big stacks as you go. He actually built those stacks and maintained them. Hard labor. That's my father, and they're still alive. So why do I tell you this? Well, I'm a lot like a lot of you. I'm in the sandwich generation. What does this mean? You know, some of you still have parents that are still alive. Some of you have your children. Some of them are living with you. Luckily, my children just recently moved out. So I'm an empty nester finally, but we're expecting maybe at one time, very soon, that maybe my wife's father will be moving in with us. I bring this up because, no different than you, how do we manage our day-to-day spending? Today's workshop is going to teach you what I do. How do we put more money in our pocket? Because as Rita said, it's not about how much you earn, it's how much you save. So we're going to give you lots of tips on that today. The other thing that is interesting a little bit about myself is I'm an avid scuba diver. I feel the most relaxing place in this world is about 100 feet down underwater. So relaxing. My wife, complete opposite. So we cruise a lot. So she can stay on the ship, she can do her own activities, and I can go scuba diving. And you're thinking, I thought this session was about taxes. What's he talking about cruising and scuba diving? Please bear with me. At the end, you'll understand how cruising and taxes actually go hand in hand. So we'll cover that. But why don't we get started? For today's workshop, we are going to be talking about some Canadian tax rules. We're going to be going over 5 tax planning strategies. It's ironic. I could do 20 tax planning strategies, but I know, it's a beautiful day out there and you don't need to be here all day. I'm going to cover 5. Some of them are going to be very basic, but maybe you've never implemented them. And you're going, I didn't know about that. Very simple things to do. Others are going to be more complex. When we get into more complex strategies, please, please, please search out a professional to help you out. Here at High Point, we have professionals. I'm going to be talking later about accountants and lawyers and making sure you're dealing with a quality financial agent or a financial advisor. Please, on the complex areas, you need to sit down and deal with somebody, because if you take a little bit of knowledge and you do it improperly, you can run into huge, huge tax bills. So this is what we're trying to avoid. By the end of it, I'm hoping that you gain some confidence, because taxes is overwhelming for a lot of people. We're going to give you some basic concepts and we want you to gain confidence. But more importantly, the purpose of today's session is to help you put more money in your pocket. So I start all my session with something like this. This is a very, very important piece. You're going about, well, what's this about? You're here to talk about taxes. This is what we call the financial pyramid. So as I mentioned, I've been doing this a very long time. I've taken lots and lots and lots and lots of courses. Yes, I've taken the IROC and the CSC, and I've taken the IFIC and the LLQP. More importantly, I've taken all the CFP courses. Every single course I've taken, they have something like this. they have a financial pyramid. So the financial pyramid starts with the basics. You need to sit down and develop a plan. And every single person needs to sit down and say, do you have your wills and power of attorney done? So I bring this up because many of you already have life insurance and RRSPs and TFSAs and other investments. Did that person ever ask you, do you have your wills and power of attorney done? We've all taken the same courses. If they didn't ask you that question, you have to question yourself. Did they sell me something or did they do things in my best interest? This is very important. You'll also notice down here we have life insurance. If you have a life insurance policy, how did you attain it? How much money do you actually get? Did somebody come down to you and say, you know what? You look nice. You need a $500,000 life insurance policy. How do they know? More importantly, did they deliver the policy to you? Because some life insurance policies, people are unaware of this, that the face value can be taxable. What? In Canada, you can have a taxable life insurance policy? If your life insurance policy was not set up properly, absolutely. So if you have a $1 million life insurance policy and it was not set up properly, the estate could have a $500,000 tax bill. Yet we hear all the time, oh, life insurance in Canada is tax-free. Not necessarily. Was it structured properly? I bring this up because one of the sayings that we have here at High Point Financial is, doesn't matter what I say. Doesn't matter what the other agent says. Doesn't matter what your friends or family say. It matters what's in the contract. Because I've been doing this a long time and I defend insurance companies. We are heavily, heavily, heavily regulated here in Canada. So when it comes to life insurance companies, they will pay no more or no less than what's in the contract. So do you understand what's in your contract? Most people have never received it. So again, if you received your life insurance policy in the mail, really? Nobody's explained that to you? Why are you dealing with that individual? So then we go up, we also have here critical illness and disability insurance. If you have somebody who said, hey, you know what? This is what you need. You need living benefits. Well, living benefits isn't on there. It's a buzzword. It's a marketing ploy. Make sure you're getting into the proper things. You'll also see RRSPs, TFSAs, RESPs, et cetera, et cetera. We did an estate planning workshop last month. One of the things we do here at High Point is lots and lots of workshops. At last session, we talked about making sure your RSPs and your TFSAs are properly structured. Making sure that you have a succession plan in place for these particular items. But you may say, oh, but we have a beneficiary. That's not a successor holder. They're two different things. So if the individual you sat down with did not explain your options on how to properly structure your RSPs and your TFSAs, your RESPs, your first-time home buyers program, you have to question them. You have to question them. That's what this session is all about. Going back to the very first slide, make sure you're getting the proper information. And don't just believe what I'm saying. You need to educate yourself. You need to be comfortable with the person you're dealing with. You need to understand that what you're dealing with can be hundreds of thousands of dollars of tax liabilities if you do things incorrectly. So why don't we get started? Well, what is tax planning? Tax planning is it's not just filling out your taxes. It's a strategy managing your finances legally to minimize your tax consequences. Legally, everything that we're going to be showing you today are legal ways for you to help you out reduce your taxes. Again, I know there's some people that say, well, we can do this, we can hide money here. And we're talking about legal strategies because the last thing we want is an audit from Revenue Canada because that can be a whole lot of mess. So when it comes to taxes, there's three ways to handle taxes. One is you can deduct things off your income tax. So we're going to be talking about certain items that you can actually deduct, reduce your income. Number two is divide. There's certain things you can do to split your income up, reduce your taxes. The third is defer. The more money that you have in your pocket and you can defer paying Revenue Canada down the road will give you more compound money in the future. Defer, deduct, divide. We're going to be covering all those three today. So let's talk about the Canadian tax rule. Canada uses a progressive tax system. I'm hoping everybody realizes that. The more money you make, percentage-wise, the more you have to pay. So we here at High Point, what we strongly suggest is obviously, if you make a lot of money, how can we bring you down a little bit more? So we're having some tax savings. So, simple question. What's your investment strategy? We have RSPs, TFSAs, and non-registered accounts. Those are the big three. So when it comes to RSPs, it's tax-deferred growth. It's flexible. You can pull your money out of an RSP anytime you want, unless it's a locked-in RSP, and we're not covering that today. But it's very flexible. But remember, everything you pull out of your RSPs, you have to pay taxes on it. It's included in income that time of year you pull the money out. So let's talk about a TFSA. Tax-deferred growth. Not bad. Flexible withdrawal. A lot of people have their TFSAs as emergency reserves. Why? Because it's very flexible. Put money in, take the money out anytime you want. And there's no withdrawal fees. There's nothing there. There's no tax consequences. So then we have our non-registered accounts. Non-registered covers a lot of things. So when you get into things such as your real estate, your gold, your precious metals, that's something different. Because when we talk about those items, those are absolutely non-registered investments, but they aren't flexible. It takes a long time to sell a house. It takes a long time to sell your gold and your precious metals. But most people who have non-registered accounts, they have, stocks, bonds, mutual funds, segregated funds. They are 100% liquid. You can get access to that money anytime. But they're highly taxable. You have interest, dividends, but of course, more importantly, you have capital gains. That's how we have investments here in Canada: interest, dividends, and capital gains. You have to pay taxes on those. So again, what is your investment strategy? You should be asking, Philip, what's your investment strategy? Mine's very simple. Pots. What? This is my investment strategy. You should have lots of pots. You should have life insurance. Yep. You should have RSPs. Yep. You should have non-registered. Yep. You should have TFSAs. Yep. You should have gold, stocks, bonds, mutual funds, segregated. You should be able to fill all these pots. That's the best investment strategy. I hear all the time, oh, I'm doing really well. I have everything in real estate. Well, real estate's good. What else do you have? No, everything's in real estate. Well, that was great last year. How are you doing now? Your market's gone down. Oh, I have everything into a certain stock. Well, you know what? That's great until the stock falls. Well, it's going to come back up, but how flexible is that? You need to have flexibility across the board. I've been an executor for many, many wills. My family farm in Canada goes back to the mid-1800s. That's how long my family's been here in Canada. So my uncle and aunt, when they passed away, I was the executor. They owned the family farm. My uncle actually worked for the city of Toronto. He had lots of pots. When I opened up his investments, he had stocks, bonds, mutual funds. There was no segregated funds back then, but he had a lot of our life insurance. He had precious metals. He had a lot of different pots. But what's interesting, when I looked at his will, and an attachment to his will was where on the family farm he'd hidden cash. He had little coffee cans of cash all over the farm. And I thought, he's crazy. He lost it. He has all this money all over the farm. Now I got to go dig it up and add it all back into the estate. But you know what? I look at it. He was brilliant. All of his pots were full. He diversified. He knew exactly where all of his money is. And for those of you during COVID, how many of you couldn't get access to your cash? The ATMs were actually out of money. The banks are closed. How did you access your cash? I've always kept that thinking that, we do have a safe at home. We have some cash in it. Why? For emergency purposes. You should do no different. You should not have all your investments in one thing. You need to diversify. And the beautiful thing about diversification, when it comes to taxes, we can now manage when you're taking certain money out to reduce your taxes. Because if all of your investments are in one particular item, then you're going to have more and more tax consequences. So I'm going to go over 5 strategies. The first strategy I'm going to talk about is how to properly manage your RRSP. When it comes to RRSPs, it's interesting. I hear all the time from people in the industry, people on YouTube, oh, you know what? You don't start investing in your RRSPs till you're in your 40s. Oh, you know what? You're way too young to have an RRSP. Oh, you know what? You're way too old to have an RRSP. That makes no sense whatsoever. RRSPs are not based on your age. They're based on your income because they reduce your taxes. If you're 40 and only making $30,000 a year, there's no sense doing an RRSP. If you're 18 and you're making $150,000 a year, absolutely, you need an RRSP. So age has nothing to do with it. It has to do with your taxes, how much income you make to reduce your taxes. So I'm going to go over a scenario. And actually, the scenarios that I cover today are real scenarios. The first scenario I'm going to cover is my son. We did this last year. As I mentioned, my son is a master electrician. They make good money. So this is my son last year. He was 28 at the time. He said to me, Dad, my plan and my goal is to retire at age 60. Okay. How much money do you have left over at the end of the year? He goes, well, I have about $5,000 a year on savings. We actually broke it down on a monthly basis, but he said $5,000 a year on savings. Okay. And he said, well, Dad, what should I do? So again, if he just put $5,000 in the bank earning no interest, at the end of those 32 years, when he turns 60, he'll have $160,000. Okay. Well, why don't we put it into either a TFSA or an RRSP? And again, you'll notice I'm using very conservative numbers. I'm using 6%. Again, our returns are much higher than that, but everything I'm doing are very, very low returns. So you can see the strategies we work with make sense. And some of you are probably going, how can you get a 6% in a TFSA? Because a lot of you have no idea what a TFSA is. We hear more and more Canadians think TFSA means tax-free savings account. So I have to put it into a savings account. I have to put it in my bank. No! TFSA is just a name, no different than an RRSP. You can put the same investments into your TFSA as you can in RRSP. You can put stocks, bonds, mutual funds, segregated funds, GIAs, RAs. You can put GICs in there. You can put your rental properties into a TFSA and RRSP. You can put your own individual mortgage into an RRSP or a TFSA, assuming you have the room, of course. So let's work under the scenario of 6%. That's all we're looking at here. So again, here's the option. My son has $5,000 a year. If he puts it into a TFSA or an RRSP at 6%, it's going to be the same growth. He's going to have over $532,000 set aside. Now, the difference is, if he puts it into an RRSP, he gets a tax benefit every year of $2,650. Okay, not bad. Again, remember, the total investment is $160,000. Is this the best option? Let's see what else we can do. Well, if we put all of his money into his RRSP, and we take his tax savings from his RRSP and put it into his into his TFSA, we now have 2 investments. So his RRSP is still going to be at $532, but all of a sudden we created a TFSA of $266,000. Simple. Total portfolio, $798,000. So is that the best scenario? Let's split it. We put money into RRSP, take the tax deduction, put it into a TFSA. Okay. So problem with the RRSP. I'm going to assume all my scenarios, the person dies at age 60. Hopefully my son doesn't, but you never know. But there is a serious tax problem if he passes away at age 60. He has a tax bill of $244,000 because when you pass away, that money has to come into income. Now, if you have a spouse, you can move the money over. You have a child that is disabled, the money can go to them. But if you don't, the money comes out. Oh, but you know what, Philip, I heard that, I have a beneficiary. My beneficiary is my brother. I'm sorry, it's still tax deductible. If you pass away, you have to pay Revenue Canada back. So what is the best option? Well, in my son's case, he happens to be married. Leah is a wonderful lady. I love her to death. And what we decided to do with them, we put it into a spousal RSP. Well, what's a spousal RSP? Well, the spousal RSP is very simple. Money goes into my daughter-in-law's name. My son gets the tax deduction. So we split it. Half the $5,000 goes into my son's name. The other $2,500 goes into my daughter-in-law's name as a spousal RSP, and they both grow. Now, you may say to yourself, oh, that's fine and dandy, but what happens if they get divorced? Hate to tell you, in Canada, after 6 months living together, they get divorced, everything's split 50-50 anyway, so it doesn't matter. So in this case, by doing a simple spousal RSP, their tax bill is $189,000. We've already saved them $55,000 by doing something simple. Welcome, come on in. Simple if we do a spousal RSP. Now the question is that the best option? I'm going to leave that here for a minute because I'm going to move on. I'm going to cover another scenario at the very end because I want you to think about the best option. So let's go over the next scenario. Pension splitting. I'm hoping everybody here deals with an accountant. If you don't, I'm going to prove to you one reason why you should have an accountant. Here at High Point, we're very lucky. Under our umbrella, we have accountants and lawyers. Love for you to deal with ours, but you already have one, that's great. But let's talk about pension splitting. I'll give you an example. Well, what is pension splitting? If eligible, an individual may be able to jointly elect to split 50% of their pension into two. Now, pension splitting helps keep the net income figure low. This can help preserve government benefits so you don't have your old AS clawbacks. And it could move you into a lower tax bracket. Okay, seems simple enough. Splitting income again. Defer, divide, deduct. We're doing defer. But how does this work? Well, here's my father. As I said, my father worked hard a very long time. He was part of the union. He gets a pension every year. My mother-in-law took care of us. Why? We had 3 boys. 3 boys are crazy. I'm glad my mother stayed home. We needed her. And after we left home, she never got a job where there was a pension. She did a lot of work, but was never part of the pension. So my dad receives $60,000 a year as a pension. If they don't do anything, he pays $16,000 in income tax. Okay. What if they split the income? The spouses jointly elect to split 50%. My dad takes $30,000, my mom takes $30,000. By the end of the day, their tax bill is $5,616, and it saves them $5,122. This is why you need an accountant. They do this automatically. Oh, but you're saying I should pay $100, $200, get my income tax done? I've just saved you $5,122. Absolutely. Use them. Most accountants take your information and help you with that information and do your taxes. Some accountants are really good and they give you tax saving strategies like we're talking about today. Unfortunately, most of them can implement some of the strategies because they aren't licensed to work with life insurance or TFSAs or RRSPs or any of the other, but they're giving you good strategies. But the simple accountants can at least save you $5,000. Okay, let's talk about a family loan. A family loan? I've never heard of anything like this before. Let's talk about a family loan. A family loan is a form of income splitting. Income splitting can allow a higher earning, and I'm using this case as a spouse, to transfer assets to the lower earning spouse. If done improperly, it's deemed to be tax avoidance, and you can end up in a whole whack of trouble with CRA. Has to be done properly. Okay, how does it work? There must be a written agreement between the parties. That's why we have lawyers here on staff. If you are going to be going into a family loan, our lawyers will help you write that agreement. The borrowing party must pay the lending party interest, and they must include that in their income tax. Again, we're not here to avoid taxes. We're here to help you reduce the taxes legally. Okay, I still don't understand this. Explain this to me. Okay, here's an example. Say you have spouse A at the tax rate of 53%. Spouse B still making money, but they're at 29%. Spouse A's received a $250,000 bonus at work. What are they going to do with it? They can invest it themselves, but they're going to have to pay taxes on it. Let's assume even lower. They're only getting 5% interest rate. Well, if they invest that, they're going to have tax problems. What we can do is spouse A, who made the $250,000, can give spouse B a loan of $250,000. And they're going to pay interest on that loan. We're going to set the loan charge at 1%. We can do that as a family. Okay, so how does this work? Welcome. Well, scenario one, there's no loan. Spouse A receives $250,000. Taxes owed, $6,700 by just putting it into a 5% interest rate bearing account. But if we do a loan, tax on the loan is the $250,000. The higher income earning spouse has to pay taxes because they have a 1% loan on that. So they pay $1,300. Spouse B receives the proceeds at 4%, pays $3,600. We have a total tax savings of $1,700. And I went over that very quickly. You're going, okay, this really doesn't make a lot of sense. What are you talking about here? Because I'm going to give my money to my spouse and we'll just split it and nobody really worries about it. This comes into play a lot with estate planning. Think about it. In Canada, we do have a fairly high divorce rate, like a lot of parts of the world. We hear from adult children, you know, my mom or dad have remarried. Boy, I hate that new spouse. We hear it all the time. They're a money grabber. They're in it nothing but for money. How do we protect the estate and still save taxes? Well, very simple. It could be a GIC, it can be a lump sum, whatever it happens to be. We can say, look, we're going to give the one spouse money. Let's say $250,000. It's going to reduce our taxes. They have some money to live on. But more importantly, because we have a written agreement that it's a loan, and the part of the estate, that spouse has to pay the money back. You're protecting the estate and reducing taxes. Well, maybe your scenario is, you know what? Like my parents. Worked hard all their life. They're still together. What, almost 60 years now they've been together? Worked hard all their life. And they have a nest egg. And maybe one of their children, well, there's three of us, they give money to on a regular basis because they can't support themselves. We hear it all the time. And the other two brothers are saying, hey, that's not fair. This is what they could do. They can loan the money to a child, let them generate all the income off of it, reduce their taxes, and the estate's protected because there is a written agreement and all that money becomes part of the estate. So when the estate's all carved out, their $250,000 comes out of it. It's a win-win-win for everybody. reduces our taxes, preserves the estate. We can go on. You may have a brother, a friend. You can do the same thing. Oh, but I hear we can't do that. I hear if I loan my brother or my friend money, there's tax consequences. We don't live in the U.S. If you do that in the U.S., there is, but again, we're in Canada. There's no tax consequences to do that. You can do it with rental properties. There's multiple avenues you can go to reduce your taxes, help people out. Okay. Corporations. Here's another tax strategy. I'm not going to have a hands up, but I know some of you have small businesses, corporations. Are you using your businesses properly? Now, we are doing a complete tax planning strategy for small business owners because there's lots and lots and lots of different strategies. At that time, we talk about buy-sell agreements, exit strategies, M&A companies that will help you build your company. We'll talk about how to properly reduce your income tax, how to properly withdraw your money. There's lots and lots of different strategies. So for the purpose of today, I'm going to cover two of those. If you're a small business owner, one of these you're going to be going, oh, wow, I need to do that right away. The other one goes, okay. But more importantly, you're going to say, these guys at High Point, they know what they're talking about when it comes to small businesses. We need to sit down with them. So what are we talking about here? Well, there's two different main strategies. One is your capital gains exemption. You right now, if you have a small business, Revenue Canada allows you to take $1.25 million of basically free money if you have capital gains. Well, what's that? Do you have a rental property? Is it inside or outside your corporation? If it's outside your corporation, let's say you bought your rental property for $500,000. You sell it today for $750,000. You have a $250,000 tax liability that you have to pay out of capital gains. It's inside your corporation. There's none. The first $1.25 million is free money to you. Oh, so you know what? What I should do is I should put my rental property into my corporation today? No. Because if you do that, there's capital gain. This is for new money going in. So the biggest strategies that we usually use when it comes to $1.25 million capital gains exemption is your retained earnings. If you are taking all that money and putting it in your personal account for your investments, there's probably a better way. You can have those investments inside your corporation, earning money, and you're going to be able to attain that $1.25 million capital gains exemption. But I thought it was $870,000. That was years ago. They're upping it every single year. We don't know what it'll be next year, but this number is going up and up and up every single year. So we bring that up because if you're a small business, that is one big advantage for you. But here's a bigger one. An individual pension plan. Well, what's an individual pension plan? Well, think of it like an RSP, but for business owners. Okay, well, how does that work? First of all, with RSPs, the maximum you can put in is 18% of your annual earned income to a maximum level. You can, add to that pot every year, but it's only 18%. With IPPs, there's a lot more room. I've never seen a business owner fully contribute to their IPP because there's so much room there. Again, taxable. Next thing with an IPP is there's tax savings on your management fees. If you have an RSP as an example, what's it invested in? A mutual fund, a segregated fund, stock portfolio that there's management fees for everything. Oh, no, there's no management fees. It's with the bank. Yeah, there's management fees with every single product you deal with. If you have an IPP, you can still have those same investments, but now it's tax deductible. Well, that's not a lot of money. But here's the more important strategy. This is why pension plans always do better than underlying mutual funds or segregated funds, because they have better tax situations than regular mutual funds and segregated funds. So if you are a business owner, all of a sudden an IPP may make sense. But here's the biggest thing. Today we're talking about taxes. We're already showing you how much tax problems people are having with their RSPs. You saw a few slides back, $250,000 lot tax liability. IPP, no tax consequences at death. What? No tax consequences at death. If you are a small business owner and you don't have an IPP, you need to get one. But all my money's in an RSP. Well, that's fine. You can move all your RSP money into an IPP. Now, all of a sudden, look all the tax strategies that you've just implemented. How much savings that you're going to have down the road. Simple. Now, I will tell you, IPPs are a little more challenging. This is why you don't hear about it from your regular insurance agent or banker, because they are a complex situation. We here at High Point, we deal with companies that come in and train us on IPPs. We're fully compliant and understand the IPP rules. So that's the big difference between dealing with us than with a lot of other companies, because when you ask them, well, what's about an IPP? And they're going to look blank. Very, very few people in our industry, even CFPs, know the ins and outs of an IPP. So make sure, if you're a small business owner, you deal with a quality person that understands how to deal with IPPs. But let's go back to our initial situation, our RRSP situation. Remember my son said, you know what, I have $5,000 a year to put in. We talked about, hey, should he put it into an RRSP? Should he put it into a TFSA? Should he put it into an RRSP, take the tax savings and put it into a TFSA? Should he do a spousal RRSP? Is there a better way? Okay, so just to remember, age 28, makes $80,000 a year, wants to retire at age 60. His budget's $5,000 a year, so a total of $160,000. Have you ever thought about doing an RRSP freeze? Well, what's that? Well, we're not going to wait to age 60. At age 50, we're going to freeze his RRSP. And what we mean by that is I'll get to that in a second. We're going to say, at 50, his current portfolio is $253,000. What a freeze is we're going to borrow $253,000 as an investment. So a loan on $253,000 is going to cost us $12,000 a year. So all of a sudden, he has his RSP and he has his loan, he has his investment. We're going to have the RSP start going down and paying the $12,000 for his loan. But Philip, any money you take out in RSP, you have to pay taxes on it. Yes, you do. But here's the beautiful thing. We deal with some banks like Manulife Bank that gives us loans at prime plus a quarter for these. Again, the rates I'm using are much higher, but again, that's what they do. The interest on that loan is 100% tax deductible. So the money that's coming out of the RSP to pay the loan is offset by the interest, so there's no tax consequences. RSP, loan, money comes out, no tax consequences. Okay. You piqued my interest. How does this work? Okay, let's look fast forward to age 60. Again, we're assuming my son's going to die at age 60, but let's look at this. The RSP actually still grows. Still an investment. Even though I said it's a freeze, it's still growing. His RSP will grow to $374,000. So not the $532, because we froze it and we're taking money out, but it's still growing. His investment of the $253,000 has grown to $499,000. Yes, we still have a loan because it's interest only. It never goes down. But remember, we have a TFSA too, $266,000. Okay, so at age 60, his RSPs are now worth $374. Because we paid off the loan, his investment's still worth $245. TFSA is at $266. Tax liability, if he dies, is $164,000. But his whole portfolio before taxes is $886. So let's give a complete snapshot here. Option 1, RSPs passes away at 60. His portfolio is $287,000. Not bad if we invested $160,000. Not bad. RSP and TFSA, all of a sudden we have $552,000 into his portfolio if he passes. Not bad. We've taken the taxes out. Option 3, we have his RSPs, his TFSAs, and other tax strategies. His portfolio is $886,000. His taxes is $164,000. That leaves us $726,000 in his portfolio. All the $5,000 investment. Tax strategies make sense. But you may be saying, okay, Philip, this makes sense, but you know what? I'm not 28. I already have $300,000 in my RSP and I'm 40. My first response to you is, you have a tax problem. This can be implemented with you at any time. Oh, Philip, I don't have $5,000 a year to work with. I have $7,000 or $3,000. You know what, Philip? I know I can get higher than a 6% interest rate. Understand we're going through a concept here. The concepts that we bring to the table here at High Point can really help you from a tax strategy standpoint. Put more money into your pocket. Save more money for your estate. At age 60, what happens if my son lives to age 90? Think of how much more money he's going to have in his portfolio. We're still doing the freeze at age 50. The most common ages to do a freeze are between 45 and 55. Not wait until you're 71 to worry about your RSPs. You do it early. You need to start managing your RSPs early. You take that advice forward, you'll be able to manage it and end up with more and more money for you as well as your family. Okay, so let's talk a little bit about High Point Financial. So I thank everybody for attending, but let's talk about us. As you heard, we do have lawyers on staff. We do have accountants on staff. We're here to help you out. We here at High Point, we bring in education all the time. We bring suppliers in, we bring guest speakers in, we bring a lot of people in to educate our agents. The other thing with our agents is we don't hire everybody. We had an agent in here a while ago looking for a job. It was interesting. She showed me this great thing that she was doing, and I looked at it, and she was talking about Roth IRAs and the IRS. And I said, this is American. And she said, oh, but the concepts are the same. No, they're not. So she never got a job here. We're very, very selective. We deal with compliance on a regular basis. We're not sitting here saying, hey, you know what? I love your haircut. You need $500,000 of life insurance. That's ridiculous. But that's what we hear in the field. Oh, you know what? I have a booth. You need living benefits. What are you even you're talking about? You need a strategy. Here at High Point Financial, we solve problems. We're solution solvers. We don't sell products. That's bizarre to me. So how do we do this? Well, the first thing is we set up a comprehensive plan for you. Our plans are very, very, very comprehensive. And the nice thing about our plans, we give them to you. We give these to you at no cost. If at the end of the day you say, you know what, I don't like those High Point Financial people, fine, you got a plan. Majority of the time people go, wow, I've never seen anything like this. These people know what they're doing. So we create a plan for you. We actually give you a checklist of what we need at these meetings to help you out. We're going to tell you how much taxes you're paying today. You'd be surprised how many people I run into that say, I don't pay any taxes. I get a refund every year. Really? Let's see your taxes, and we'll show you exactly how much money you're paying in taxes. We're going to show you how much tax you're going to pay tomorrow. We're going to show how much money your estate's going to have to pay in taxes. And again, in Canada, there's no estate taxes, but there's RSP taxes, there's probate fees, there's also capital gains taxes. We're going to make sure you're prepared. We give you an independent review. We give you a full analysis, no product, and no cost to you. So let's look at our checklist. First thing we're going to ask you is wills and power of attorney, tax returns, pay slips, company benefits. How many of you have a company benefit you've never read or had read to you? We hear it all the time. Insurance products. Maybe you already have some great life insurance. Maybe you already have disability. Maybe you already have some critical illness. We will make sure all of that. Pensions. When it comes to pensions, do you know where all your pension money is? A lot of Canadians have no idea where all their pension money is. We talk about that. RSPs, TFSAs, home buy. We look at everything. Non-registered investments, your big expenses. We need to know your mortgages, your car payments, any other big expenses. If you declare bankruptcy, there may be some clauses in there that we have to worry about. Maybe you've been divorced. We need to look at your divorce decree. How would you like us to set up a plan for you, and then you've never showed us your divorce decree, and you have no idea that half your money is going to your ex-spouse at retirement? We see that happens. We need all this information. Well, Philip, I'm not going to give you any information. Okay, then we won't be clients. It's that simple. We here at High Point, we're highly compliant. We need this information. I understand a lot of it's personal. But remember, we're a fiduciary. We have a fiduciary responsibility to do what's in your best interest. If we cannot gather all this information, we cannot be clients. Yeah, but those other people are selling me that $500,000 life insurance policy. Oh, that other company's selling me an RRSP. That's where we're different. We want to do what's in your best interest, and we can't do that unless we have all the proper information. So take the time, gather it up. Well, you know what? I can't find my tax returns. Well, then that's why we ask for your pay statements. We'll work it out. Oh, you know what? I'm not quite sure where our benefit book is. Don't worry about it. Again, we are very knowledgeable about a lot of different companies, so maybe we can work through that, or at least we can tell you where to find that information. I have no idea where all my pensions are. We'll help you out with that. Oh, you know what? Do you really need to see all my RSPs? Absolutely. We need to do the whole comprehensive plan if you want us to help you out. So, what's going to happen at this meeting? Well, we're going to get to know each other. We're going to sit down and talk. We'll answer any questions you might have about anything you've learned here today, or any questions you might have about a personal situation, because a lot of you have personal situations that you want to ask about. We sit down, we'll ask those, we'll talk about it. We'll then create a comprehensive plan. We spend 1 hour together. We're not going to come in and pack out for 3 or 4 hours. We'll spend an hour together. That's all we need. We sit down and we talk. Then we develop this beautiful plan for you. The size of this plan depends on who you are, how much information you have. Some of these plans can be up to 100 pages long. Very complex, very detailed. Lot of information here. A lot of pretty graphs too. We give you a lot of information. But here's one of the big things that I love. This is one of the plans I just pulled out, happened to be this week that we did. At age 60, this person has a $573,000 tax bill. Has anybody ever showed something like that to you? The one slide that I didn't put in was the sheet before that. Tells people how much percentage-wise income tax they actually pay. More and more Canadians have no idea tax consequences. None. I don't know if any of you heard. We talked about this at the estate planning session because it happened that week. We had a lady, she was in the paper. Her parents died. And they didn't do anything. And all of a sudden, the family had a $660,000 tax bill. They had a cottage, they had RSPs, they had a home. And her point was, well, government of Canada should be doing something about this, so we as beneficiaries should be getting all this money without worrying about taxes. No, they already have. That's what we do. Her parents didn't get the proper information. We will show you how much taxes you're going to pay. More importantly, how you're going to reduce it. That's why people sit down and talk to us here at High Point. So, tell me more about this meeting. Well, what's going to happen? We're going to ask lots of questions that we can't sit down and talk to you personally. Because again, as confidentiality, we're going to ask you lots of questions. We're going to spend an hour. Are you going to try to sell something? We can't. We're here to gather information. We can't do anything until we create the proper plan. How I feel? You're going to feel smart and confident. Why? This is for you. It's not general knowledge. We're going to give you the information so you feel smart and confident. Where are we going to meet? Where would you like? Home, your business, here at the office. We're not going to meet you at a coffee shop. Why? Because, it's not confidential there, but we're going to meet you in a private place to talk about. So what's the next steps? Next steps is if you like us, you join our company. We'll help you out with a plan. That's what we do. If we need to get you into an RSP or TFSA or whatever it happens to be, we do it at that time. But more importantly, you have the information now. I started today by saying Education is one thing nobody can take away from you. How much taxes are you going to pay in the future? How do we reduce those taxes? Okay, prior to me getting into a little bit of Q&A and then wrapping it up, I want to look at, everybody's received a folder here today. All the information is in here. One of the things I do ask is we've given you a work page here. Please, we ask everybody to fill the work page out. We want to know more information from you. Here's the reason why. We do a lot of these workshops. If you want a specific workshop for you, for your company, we will help you out, so please fill that out. If you have suggestions, fill it out. If you'd like to sit down with one of your advisors, put down a couple times. This paper, please give this to the person who invited you here today. Okay? After that, we do have offices open. If you want to sit down and talk to them, because there's going to be a lot of questions here, and you say, let's sit down, let's talk, let's set up a meeting, great. The meetings in the rooms, again, I don't think anybody here has anything on the checklist. So we're not going to be sitting down creating your plan, helping you out, but we'll be able to answer some of your questions. But right now, I know I'm running a little late, but I do have a few minutes for Q&A. Does anybody have any questions that I can address today? Yes?
So the example where you froze the RRSP.
Yes. Yes, thank you.
So when you say freeze, after the age of 50, where is the $5,000 per year going? Is that going into the...
It is going into the RSPs because we still need to build the TFSA and the tax deductions.
So you still continue to contribute to the RRSP.
That is correct.
But the value is decreasing by the amount of the, whatever you think for the loan.
That is correct. Yep. And again, with the RSP freeze, oftentimes we still put money into the RSP, but sometimes we don't. Each individual person's different. In a case like this, we would. And more importantly, in a case like this, because the person's still young, chances are, as they get older, we're going to be increasing that from $6,000, $7,000, $8,000, $10,000 as well. But good question. Thank you very much. Anybody else have any other questions? Yeah, sure.
So for a spousal RRSP,
yeah.
Like say if I were to contribute to my spousal RRSP, does that take up the room that is already in the RRSP? Or
No. Great question. The question is, if I contribute to a spousal RSP, does that eat up my wife's RSP room? No, it eats up mine. It eats up mine. She has the investment, but it eats up my room. I get the tax slips. Okay, any other questions today?
What's the difference between the RSP and RIF?
Good question. What's the difference between an RSP and a RIF? It's really no difference. Your underlying investments are the same. But where it comes into, a RIF is a way for you to take money out of your RSP. So Revenue Canada forces you at the last day, December 31st, the year you turn 71, you have to do something with your RSP. So you have options. You can cash in your RSP, and I've seen it. You end up with a huge tax bill. You can buy an annuity. That's what pensions are. You buy an annuity, so you have a monthly income. Or you can buy a RIF. You take out a RIF, and all it is the same investments, but now it's a way for them to give money over to you on a monthly, quarterly, or yearly basis. Okay?
So technically, you can withdraw some amount of percentage of amount of RSP under the CRL.
That is correct. Yep. Correct.
So the remaining money goes in like RSP.
100% correct. 100% correct. And here's a flaw with a lot of people. They think they got to move the money from a RIF over into a bank account. They lose all the growth because, again, you look at my parents. They moved their money over at mid-60s, and they're in their 80s. They would have lost 20 years of growth if they just put it into a bank account. Great question. Any other questions? Okay. Again, thank you very much for attending. I will say one last